The automatic transfer had already gone through by the time the coffee finished brewing. It left the checking account every other Friday, moving into a 529 plan opened years earlier when the children were still in elementary school and college felt abstract. The amount had once seemed manageable, almost symbolic. Over time, it became fixed, immovable, embedded into the structure of the household as firmly as the mortgage payment or the health insurance deduction. By the time high school started, the contribution was no longer a gesture toward the future. It was a line item that shaped everything around it. Their combined income had risen gradually over the years. Promotions came with modest salary increases. Annual raises kept pace with inflation some years and fell behind in others. On paper, they were earning more than they had a decade earlier. The gross income suggested progress. The net income told a narrower story. Federal withholding, state taxes, social security, Medicare, retirement contributions, health premiums, and the automatic college savings transfer left less flexibility than the salary numbers implied. The 529 plan had been opened during a period of relative stability. The mortgage was new then, locked at a fixed rate that felt responsible. Childcare costs were temporary and visible. Retirement still seemed distant. The decision to begin college savings early had been framed as disciplined and forward looking. It aligned with how they understood adulthood. Prepare now, reduce uncertainty later. No one described how permanent the preparation would feel. As the children moved into high school, expenses shifted. Club sports required travel. Advanced placement courses came with fees. A second car was added to accommodate overlapping schedules and commutes. Auto insurance climbed. Property taxes rose incrementally each year. None of these increases were dramatic on their own. Together they formed a steady pressure that narrowed the monthly margin. The 529 contribution continued unchanged. There were years when investment returns in the account looked encouraging. Quarterly statements showed growth that exceeded what their own savings account earned. It created a quiet reassurance that the discipline was working. At other times, market declines reduced the balance in ways that felt abrupt. The long horizon made volatility acceptable in theory, but it still registered emotionally when numbers moved backward. The contribution amount did not adjust to the market. It remained constant, transferred automatically, regardless of what the statements showed. Retirement savings had always been part of the plan. Both participated in employer sponsored 401k plans, contributing enough to receive the full employer match. Increasing those contributions beyond the match had been discussed several times, especially after reading articles about compounding and long term shortfalls. Each time, the conversation circled back to the same constraint. The monthly cash flow could absorb either higher retirement contributions or sustained college savings at the current level, but not both without changing something more visible. They left retirement contributions steady and maintained the 529 transfers. The children never saw these calculations. What they experienced instead were small refusals. Vacations shortened. Restaurant visits became occasional rather than routine. Home renovation projects were deferred. A bathroom remodel remained in planning stages for years. The kitchen appliances aged beyond their expected lifespan, repaired more than replaced. The savings for college continued, quiet and uninterrupted. When the oldest child began visiting campuses, the abstract numbers in the 529 account began to intersect with actual tuition figures. Private universities listed annual costs that approached the couple's combined take home pay. Public in state options were less extreme, but still substantial once housing, fees, and books were included. The account balance, after years of disciplined contributions and mixed market performance, covered a meaningful portion, but not the entirety. The gap was visible. Financial aid letters introduced new variables: grants, subsidized loans, unsubsidized loans, work study. The language was formal, structured, and impersonal. The remaining balance each year would need to be paid through a combination of the 529 withdrawals and either current income or borrowing. They chose to use the 529 funds first, preserving cash flow where possible. The automatic transfers into the account stopped during the first year of college, replaced by automatic tuition payments to the university. The household budget did not become looser when the transfer ceased. Instead, the tuition bills filled the space. At the same time, retirement felt closer than it had when the savings plan began. One of them had crossed into their early 50s. The other was not far behind. Employer retirement projections estimated balances at age 65 based on current contribution levels. The projected income replaced a portion of their current salary, not all of it. The shortfall between projected retirement income and existing expenses was not catastrophic, but it was persistent. Increasing retirement contributions now would require reducing discretionary spending further or extending the working years. The second child entered college 3 years later. The 529 account, having been partially depleted by the first child's tuition, no longer held the same reassuring buffer. Market performance during those years had been uneven. Withdrawals during a downturn meant selling investments at lower valuations. The remaining balance covered less than originally anticipated. Parent Plus loans were considered and ultimately taken for a portion of the cost. The interest rates were fixed but higher than their mortgage. The repayment terms extended beyond what they once imagined their obligations would include. By then, the mortgage itself had entered its later years. The principal balance was significantly reduced. There was a visible end date. For a brief period, it seemed possible that the conclusion of the mortgage would coincide with the end of college tuition. The timing did not align perfectly. There was overlap, and the Parent Plus repayment schedule extended further. The 529 plan had accomplished what it was designed to do. It reduced the amount borrowed. It created options that would not have existed without early contributions. It also restructured the household's financial trajectory in ways that were less visible at the beginning. Career decisions had been made within the boundaries created by that steady transfer. One opportunity to relocate for higher pay was declined years earlier because it would have disrupted the children's schools during critical academic periods. Another position, offering commission-based upside, was considered too volatile given the fixed obligations that included both retirement and college savings. Stability was prioritized over potential. The children graduated without excessive student debt compared to many peers. Their loan balances were manageable relative to entry-level salaries. They moved into apartments, signed leases, began their own automatic payments. The parents attended graduations with a sense of completion that felt financial as much as emotional. The household budget, however, did not return to its earlier form. The Parent Plus loans required monthly payments. Retirement contributions were increased modestly once tuition bills ended. But the compounding years lost during the peak earning decade could not be restored. Catch-up contributions were made when possible. The retirement account balances grew, though the projected income at age 65 remained slightly below what earlier calculators once suggested. Home maintenance projects, long postponed, now competed with retirement funding rather than college savings. The roof eventually required replacement. The HVAC system failed during a summer heat wave. These were not discretionary expenses. They arrived independent of tuition schedules or loan repayment plans. Now, in their mid 50s, the mortgage nearing completion and the parent plus balance declining slowly, the couple reviews their accounts with a different orientation. The 529 statements have been replaced by loan amortization schedules and retirement projections. The checking account still processes automatic deductions, but the destinations have changed. Income continues to arrive bi-weekly. Taxes continue to withhold. Insurance premiums remain substantial. Property taxes adjust upward. The structure of American middle income life remains intact. The children visit occasionally, bringing stories from early careers shaped partly by degrees financed through years of disciplined savings. Conversations at the dining table include references to 401k enrollments and health plan options, topics that once seemed distant to them as well. The household feels quieter now. Fewer daily expenses tied to school activities. Fewer scheduling conflicts. More visible aging in the home itself. The financial architecture built around college funding has largely completed its purpose, but its imprint remains. Retirement is no longer theoretical. Social security statements are reviewed annually. Employer benefits seminars are attended with attention rather than abstraction. The gap between projected retirement income and desired stability is measured carefully, not dramatically, but with awareness. The 529 plan statements, once opened with curiosity about growth, are archived. The account balances have served their function. What remains are the long term consequences of prioritizing one future obligation over another during peak earning years. The decision had appeared responsible. It still does. It simply did not end when the children enrolled. It extended through career choices, home maintenance delays, loan repayments, and adjusted retirement timelines. It reshaped the budget not through crisis, but through consistency. On some mornings, the coffee finishes brewing and no college transfer leaves the account. The checking balance sits slightly higher than it did a decade earlier on similar dates. Yet the space it occupies is already claimed by something else: loan payments, increased retirement contributions, property tax installments. The structure holds. The years ahead are defined less by tuition due dates and more by retirement account balances and healthcare projections. The earlier discipline remains visible in framed diplomas on a hallway wall, in loan statements nearing their final payments, and in retirement projections that continue to adjust. The realization settles without announcement. Funding college was never just a savings goal. It was a reallocation of an entire decade of financial momentum. The house is paid down, the loans are declining. Retirement approaches with both adequacy and limitation. The automatic transfers continue, only pointed elsewhere now.